Hello, everyone. Dear members of the Indo-German Chamber of Commerce, welcome to the second part of our workshop about COVID impact on transfer pricing, jointly with ASA and Associates. My name is Sabina Pandey, and I am the head of the legal department at the Indo-German Chamber of Commerce, and also the regional director of our Kolkata branch. Thank you for tuning in today's session. During the first part of our webinar, our eminent speakers elaborated on the various implicit areas, for example, due to changes in the flow of sales transactions. We also saw several practical scenarios explained depending on the situation a subsidiary can face with the changed processes in the COVID situation. Towards the end of the webinar, I saw that the speaker mentioned that there cannot be enough documentation to support your transfer pricing document. Tax authorities in India and all over the world are going to be aggressive, and most importantly, finance professionals in charge of transfer pricing have to know their business well. Hence, today we look forward to the second part of our webinar to understand issues related to defending your transfer pricing. We are pleased to have with us once again our two speakers from ASA, namely Sunil Arora and Karthik S. For the benefit of those who could not attend the last time, I'm going to introduce them once again now. Sunil Arora leads the taxation function of ASA in the Delhi NCR region. A chartered accountant with more than 2 decades of experience, he has assisted various SME companies and large multinationals in devising transfer pricing policies and defending them before the tax authorities. An expert on international taxation, Sunil has advised several foreign companies on investment structuring into India, taxation of expats, tax planning avenues, and other facets of cross-border taxation involving interpretation of complex bilateral tax treaties. Sunil has successfully represented his clients in contract negotiations and various tax and appellate bodies. Our second speaker, Karthik S.S., has joined ASA as an associate director in the tax practice from July 2020. He's a graduate in commerce and law with around 10 years of experience, primarily in the area of direct taxation, with transfer pricing as his area of specialization. So now, without further ado, I will hand over to Sunil and thereafter Karthik. Let's have a good session. Thank you, everyone.
Thank you, Sabina. Thank you very much for this very kind introduction. And welcome, everyone. I think the last session, we also find it very interesting to do these sessions with the IGCC and all our colleagues at IGCC, Sumit, Sabina, Meera, Sana. I think they've all been very helpful and very encouraging in the way this was done and conceptualized. Friends, I think, can you get the presentation up, please? I think transfer pricing, everybody knows, and as I said last time also, those of you who were here, I did mention very clearly that transfer pricing happens to be the largest area of dispute, and obviously, dispute is never welcome in an economy, especially like India. And therefore, what can you do at your end? What are the practical aspects that you can sort of understand to gauge the extent of the problem that you're facing? And once you understand the problem, once you understand the extent of the problem, once you've analyzed the problem well, it's easier to handle it, or at least know what lies ahead of you. So I think that has been the perspective with which this entire presentation has been carved out. Part one was primarily to understand, just give me the next slide, please. That's easier to understand then. Next slide, please. So friends, part one was easier to understand, and the aim was specifically to make you appreciate what are the impact areas that have arisen due to COVID. COVID obviously, has disrupted the entire business cycles. Anything and everything that we knew as normal has changed because of COVID. And therefore, very important to understand where does it hit, where does it impact the most, and that is something that we understood last time. And then once you have understood by way of practical scenarios, how do you analyze the problem? Once you have analyzed the problem, how do you defend this entire understanding that you have gathered? So I think today what we're going to do is we are going to take you through some very critical aspects that touches the very sensitive area issue of documentation. And why documentation is critical is because A, it's mandatory by law. B, documentation also is something that you can generate in a contemporaneous manner. So for example, if there is a business situation that you face today, if there is a supplier renegotiation that you're doing today, it is not always possible to gather the same information, the same paper trail, the same audit trail as you can gather today. You can't gather it tomorrow. So when you have a tax scrutiny, a tax investigation coming up, how do you sort of go back and understand, try and live through the transaction again? And that is where, discussions like these come very handy. And we thought, today there is a habit that by the end of the year, you will just leave it to your accountants or your advisors, your tax people to just sort of compile together what is required under law. But there is so much beyond that, and especially given the COVID scenario, there will be so many issues that you will face. And unless you collect and understand the information at the right time, you will obviously face a dilemma at a later date. Next slide, please. So what are we trying to do? A quick recap of what we did the last time, and this is a precursor to what we're going to discuss in the main discussion today. So in the first part of the discussion, we focused on two aspects. We focused on the issue of identifying my problem, what is the impact of COVID and any other extraordinary situation for that matter. We did a study on that, and we realized that transfer pricing is not an exact science, but this science is based on a very critical element called function, asset, and risks that a business undertakes. Now, because of COVID, anything and everything went for a toss. Your contractual obligations, your funding arrangements, the digitization that happened to you, your inventories, the timing, the cost, anything and everything had undergone a change. And therefore, there had to be an impact. And again, this impact is not just fixed for a business. It could be different for different group entities. It could be different for different business divisions. It could also be different for different times. One year you may do very well. Next year you may, see some challenges, or vice versa. Or you might have an impact that might run over multiple years. So that's the impact that we try to understand. And my colleague Karthik gave away some very crisp 4 or 5 situations with live examples how this could impact you. And then once you've understood the impact, identified the pain points, you try and understand the analysis, you try and conduct the analysis, and you see how much is it hitting you, right? And when you discuss this particular section, the best thing that you do is, and the best mechanism that you handle this with, is that you try and draw a statement. Let's say the impact that you see is on your financial statements. So the best way to analyze your financial statements for a period that has been impacted is to draw the statements by taking away the impact of that particular incident. So let's say COVID was an extraordinary impact. COVID is an extraordinary impact, good, bad for some. But if you were to understand the real impact, analyze the real impact, you will have to draw a situation in a but for COVID scenario. And once you have drawn a situation in a but for COVID scenario, you will try and understand what is the component of the impact of COVID that you should take care of. What is it that you have to explain to the tax officer? And obviously, since we are in a situation where lockdowns are being lifted gradually, every state is released, they are being more liberal in the way they implement lockdowns. Industry is coming back to near normal, nowhere close to real normal, full normal, but near normal. And therefore, if today you were to carry out an analysis of a pre-COVID, during COVID, and post-COVID scenario, you will exactly know your problem. And this is where the analysis part ends. Now you know your problem, you have analyzed the impact. What next? The next part is documentation. And I think when you talk about documentation, you know, when everything is good, nobody wants to question you. When you're making good margins, when you're declaring good profits in a particular jurisdiction, nobody bothers. But the problem is when you incur losses is when you realize the real need for importance. And COVID is just one such instance. There could be many other scenarios where you could incur losses. And how you understand, analyze, and document these losses is the trick of the game. And so we thought it will be important for you to understand and go a bit deeper into losses. Again, losses could have different characteristics. So unless you understand what losses are, just give me the next slide, please. Unless you understand what category of losses are you going to see or you're going to experience, you will never be able to understand how to identify the critical factors. What are these salient features in any particular loss? So we thought we could, for the sake of this discussion, we could distribute the losses into, let's say, 4 critical sections. There could be more, but on a high level basis, you will not find anything beyond this. So first section is something dealing with a scenario like today. You are in a COVID scenario, you are dealing with an economic downturn, you are dealing with a recession period, and therefore, how to understand this as a situation. What are the salient features in a situation like this? And then, there are humans that drive business. There are CEOs that drive business. They are humans. And therefore, there is a natural tendency sometimes to take risks. There is a tendency to take, to make wrong decisions, to make aggressive, bold decisions. They might backfire and you may end up making huge losses. Let's say in short term. Long term, you might make better money, but business strategy could lead to losses. So we thought that could be another section that we could discuss. Then the losses could be startup related. You are hearing a lot of this term called startup a lot nowadays. Startup has a specific significance to the government. Startup is recognized as a specific business segment for most of the jurisdictions now. But what is that the startup invests in? Why does startup make losses? Where are the issues? What are the salient features in a startup that helps to identify the problem, and how do you document it? And then Forex, given the state of economies, there is a lot of fluctuation that is happening. There is a lot of Forex is very volatile, especially when you deal with India. You import into India, and therefore, the cost of your imports keep going up. And how do you deal with these losses? How do you justify these losses before the tax authority? We thought this is a good landscape for you to understand, and also sort of justifies the topic of documentation as a whole, right? Once we are done with this, your expectation should be, you should be able to ask the right questions to the right people. And once you've done that, your job becomes easier. It's more practical. It's more interactive rather than just taking guidance or just handing over documents to somebody else. Next slide, please. So what is an economic downturn? What is a loss that could be recession related? So friends, a simple example is the 2008 financial crisis. We all know what happened. The markets in the US crashed, and that had a global impact. Businesses went down in a matter of days. The COVID situation today, not exactly the situation of COVID, but the lockdowns that COVID followed and that the governments implemented as a matter of precaution, that obviously left businesses at a standstill. Businesses could not move. Anything and everything changed. Any business assumption that you used to allow, that you used to rely on, look at your buyers, look at your suppliers, look at your customers, your quality control, your logistics, your inventories, the nature of demand, the product that was being demanded. Suddenly everything changed. Last I heard, in the beginning of the COVID, Maruti Suzuki started making medical ventilators, right? So such is the flexibility that the businesses were willing to understand and go to that extent. So all the business assumption changed, and whatever you were doing were tested against the new normal, what was happening around you. You were trying to cater to the new requirements in a very restricted zone, and that obviously led to a lot of changes. Anything and everything, friends, whatever you understood as business, sitting in this office and doing this presentation was also a privilege at that point in time, right? Doing this kind of an interaction today, we are doing this interaction thanks to an automated platform. Even this was not fully evolved when the first lockdown happened. So anything and everything was new, was something that was unfolding before us, and we were in complete awe of the situation. And so businesses try to manage, right? And when businesses try to manage, they use a different path than they are used to. For example, a company that deals in a particular manner, a company that imports a particular set of raw material from, let's say, the headquarters based outside of India. Now, they obviously could not get access to the raw material. So what they did was they instead imported the quality control mechanism of the headquarters, and they try to apply that quality control to the local market here. They try to find raw material in the local market here. These are survival tactics. But what does it lead to? It leads to a situation where the norms, the policies that you had agreed to are completely changing. Whatever was is not existing now. So how do you document a situation like this? Frankly, there is no yes and no in this situation. There is no clear answer. There is no black and white that I can give you. All I can give you is that do not consider any documentation that you generate as less important than the other. So you have taken a decision. I'll tell you how we have looked at some of the examples. So a typical example of, let's say, employee policies. Let's say the employees were given facility to set up an home office. Companies like TCS, IT companies where the employees runs into thousands and thousands, they obviously have spent millions of rupees in a facility like this. Now, how do you decide this, right? Now, why should the tax officer allow buying of assets in a company at the location of the employee? Why should he do that? He's under no, because, let's say Tata's or anybody who did this decision, let's say they were in an SEZ, and SEZ has custom bonding rules. And when you have these custom bonding rules, all that you're supposed to buy, all that you're supposed to deploy must happen in a bonding facility. Now, why should the tax officer, let's say the SEZ officer, why should he agree to the fact that you have bought something that you've given to employees? The assets are not based in the custom bonded area. The assets are based in the premises where the employees are working from, their home offices or the guest houses they are based at. Why should they agree to it? Now, notwithstanding, and forget the fact what SEZ rule says, what am I expected to maintain in this situation like this? So I think, first of all, documenting my discussions with the client, very clearly discussions with the client, that what is it that they want in terms of output. The client wants the output in the same manner as they were getting the output earlier, which means I need people on the ground. I need foot on the ground. And once I have boot on the ground, of course, I want these people to work. They cannot work without the system, right? So what should be my response? I'm the management. What should be my response to the situation? I'm going to document my response that we have discussed this with the customers. Customers are able to compromise on the response time, let's say by 10% or 15%, but they want output in the same manner. They want the same security controls. They want the same protocols. Everything has to be the same. We want the deliveries to happen, let's say, in T plus 10% extra time, right? This is my response to the entire situation. Now, I'm going to document every decision right from the word go. So what did I think when I was making this policy? Why did I decide eventually that this is important for me to have these assets placed at the facility where my people are working, right? How did I take my people into confidence? How did I arrange the logistics? I have to show to the authorities that, look, there are assets that I bought, and these were physically delivered to the location of the employees. And how did this then help me in stabilizing my operations, right? That is the most important part. So I had, because of lockdown, everything came to a standstill. I am the management. I took a decision. I documented that decision. That decision led to restarting of my business. That led to me able to come back to my income generating capacity. This is a complete chain of thought process that I've documented, right? And besides that, there is a lot of things I can do, but just you know you have to follow your instinct. You have to follow a document trail in whatever decision that you're taking. And therefore, as I said, there is no right or wrong. These documentation that you maintain are going to be specific. They are going to be very specific to your business, to the situation, to the problem that you're dealing with. I gave you an example of deputing people at home, but let's say, for example, you're giving away the office, or you are spending money on the office while you're still not in the office. The tax officer could ask, why are you still paying for the facility which you're not using, right? And therefore, you have to record your discussions, document your discussions with the landlord. What are the factors that you put before the landlord? Any exchange of memos, emails, what is the response of the landlord? How do you deal with the situation? So you have to create your own documentation. Nothing is enough, right? So understand each problem and create a paper trail. Give the auditor a chance to go through the trail of your thought process. Give them mirror the same viewpoint as you had imagined when you were taking the decision. And I think you cannot do beyond that. And therefore, it's all customized. Right? Next situation, please. Next slide, please. Business strategy, friends, I think essentially we are talking about a situation where everything around you is normal. The industry is not suffering a loss. But let's say, due to an internal decision, and this internal decision could be a new product that you had introduced in the market, it did not do well, or it did not do well initially, right? Or your pricing was not right, or your marketing was not enough, or your marketing was excessive, and the recovery of the marketing cost is not enough, right? You are trying to diversify. You have taken too much of work at one go, and obviously you're not able to substantiate the expenses. Your expenses are not being absorbed at the same rate as your income, right? Or let's say a bad decision taken by leadership from the top, right? Sometimes you are just trying to incur loss to be able to maintain your market share. And I have a very good example to give you there. So what do you do in a situation like this? I'll give you an example, and then maybe we can discuss this further. So we were dealing with a situation where one of our clients, a French company, a European company, they were trying to maintain their market share by incurring losses in another product segment. So this company was into supply of smart cards, and these smart cards, obviously, they are in phases. The smart card that you use today is a high capacity card, but we started with a low capacity card. And when this low capacity card started, they were the market leaders, right? As they started developing new and new products, there were other suppliers in the market. So what they did was they sold these cards at a throwaway price to the entire set of buyers. All the telecom buyers here in India bought in quantities, right? And the price was minuscule, even below the cost at which the cards were procured. Now, when the matter came to us to scrutiny, we said this is the decision that was taken in year one to maintain my share and market dominance in year 2, 3, 4, and 5, right? And therefore, the loss this year in year one, when I incurred these losses in this business division, this loss should be treated as extraordinary loss because I had not imagined this loss. And this should be spread over multiple years because the benefit of this loss by way of an enhanced market share, I actually was able to utilize in subsequent years. And what we did was we showed them a trend analysis. We said, look at my 5-year sale. While one product where I incurred loss is going down, the graph very clearly showed it helped me contain the market, hold the market, and sell higher margin products to the same customers. And I was able to absorb this loss over the next 5 years. Obviously, the matter went at different levels, at different appellate levels. The officers' contention was, they said, you know, we don't agree with you because it's an afterthought. Afterthought. Afterthought is an argument you will get every time, if and only if you are not able to work on your documentation at the time when the event occurs, right? Afterthought is something that you have to avoid, very deeply avoid. So what did we do at that situation, right? We started going through our financials, because we also obviously at some stage started believing that it's an afterthought that the management is giving to us as advisors. We looked into the financials, we looked into the notes to accounts. There was no mention of an extraordinary event that had happened. So we looked at all the accounting standards. There was no disclosure as per any accounting standards. There was no authenticity. There was no accreditation by the auditors. The auditors had not endorsed any extraordinary situation. Then what ground could we find to establish to the tax officer this was not an afterthought? We looked at the director's report. Now, director's report in SMEs, in small companies, is generally a standard affair. You will just write some standard secretarial items and then you get done with it. However, this company, the corporate governance norms are very, very strong. And fortunately for this company, the director's report mentioned a very clear business strategy where they had written that we realize, the management realizes that these smaller capacity smart cards are going to phase out. And there is a deliberate attempt that your management is making to retain the market share. So there was some bit of the story that was there in the director's report. And bingo, we hit the nail. And that's where, you know, we went back to the tax officer, we went back to the authorities. The officer obviously did not agree. He still said it was an afterthought on some basis. But the appellate authorities agreed. And they said that the management had taken a conscious call. And it's a golden rule that the tax officer cannot guide the management how and on what to spend. It's the management's perspective. It's the management prerogative. And therefore, if this was a decision that was taken, there has to be some solution. And they have obviously offered a solution that we again contested. But again, all I'm trying to tell you is that from a zone where it was alleged that this was an afterthought, because we had the right documentation in the director's report, the allegation of afterthought was handled very, very well. And therefore, friends, it's extremely, extremely important that all your internal documentation must justify the decisions that you have taken. And this applies to everything, right? In the last slide, we dealt with the situation emerging out of a recession, or let's say an event like COVID. You could very easily document any extraordinary decisions that you would have taken in the internal management. So for example, in Singapore, now they've said that the impact of COVID must come out very clearly in your financial statements. They have prescribed a rule which says that you must do that. Now, that they're simply following a justification where the onus then shifts to the tax officer, because you have disclosed very well, the onus shifts to the tax officer whether he agrees with your proposition or not, right? But it's very important for you to maintain internal documentation. I gave you a classic example that saved us, the disclosure in the director's report that saved us. Similarly, anything and everything that you can gather on size, share, competition. I gave an example where we said that this is how we were able to retain the market share. Now that was a very critical piece of market information that helped us, right? And obviously, if you go further, you talk about future profitability projections, so on and so forth. Again, specific, but this is a situation where the situation we are dealing with is an outcome of a business decision, not necessarily a complete market downturn. Again, the documentation will differ, but again, nobody is a judge what is perfect documentation. Next slide, please. So startup, I mentioned about startup. I said this is a term that you hear very often now. Now, what is peculiar about startups? Now, these startups, you know, they will spend a lot of money. I wish this was there in our days when we were looking out for jobs. They will hire the most expensive resources just on the basis of an idea, right? So they will invest heavily in fixed resources, in working capital. And that's the style of their working. They work on a lot of startups that we know, especially in the e-commerce market. They are working on a cash burn formula, right? It's a lot of money at stake, right? They don't expect profits in the shorter run. They want to capitalize on the idea that they have generated. So the mindset, the ideology is different. And therefore, they may not be very interested to document what they spend, right? Whereas the reality is that the tax officer is going to look at a startup in the same manner as he's going to look at a growth business, right? And if they don't take care of their losses, these losses will snowball until the product is monetized, until they have capacities, until they find a market, until they find a buyer, until you and me start to giving them some revenues, right? So therefore, whatever they might do, it could be pricing strategies, cost strategies, their marketing model, it could be productive, unproductive, it could be sheer timing, it should be a wrong market, it could be anything that they have bought but they cannot absorb in terms of human resources, assets, technology, anything and everything, right, is going to lead to losses, right? So what is it that is most critical for a startup? For a startup, obviously, the entire business is built on an idea. So what is that business plan that they have relied on? You must document it well and show it to the tax officer, right? And the business plan that you present should be as strong as you present before the investors, because the investors will give you money, the tax officer will give you mercy. And both are equally important for a business like this, for a stage like this, right? So anything and everything, friends, I'm not going to go into more detail. More or less is common. Again, we are talking about specific decisions. But again, the most important part is what is the idea that you wanted to capitalize on, right? And again, whatever idea that you had will obviously leave the business, the capacity of the business that you generate unutilized. And there comes the issue of adjustment. And Karthik is going to deal with adjustments very exhaustively, but this is immediately connected. Next slide, please. So Forex is a very known subject. I'm not going to dwell deeper into Forex. But again, if you have a short-term loss, it's absorbed into the P&L. If it's a long-term loss, that just generally gets adjusted to the cost of the asset that you've acquired or the liability that you've acquired. Now, companies, what is it that you can do? The only thing that you can do in this case is there has to be a very clear transactional trail of the event that has happened, right? There should not be an allegation that this is a transaction that is made up. For example, where you had an option to do a transaction in both Indian currency and foreign exchange, let's say loans, right? You could buy a foreign currency loan or an Indian currency loan because the head office had both options. You should not be alleged to have made up or colored a transaction to only buy a foreign currency loan or take a foreign currency loan because it could give you more losses in terms of fluctuation, right? So have a very clear strategy in place where you show the transactions, how you try to hedge this loss, and how it was beyond your control, beyond a particular time, beyond a particular point, and therefore that leads to a situation where you have to take it to your financials. And whatever discussions we've done, friends, is going to lead to a situation where, given the next slide, please. And this is the last slide on the documentation part. What is it that you want to do? All you have to do is you have to make a strong case. And again, it's anybody's guess what is a strong case. And the only mantra that we have learned over so many years is that whatever you find material, now you understand how to see your losses, how to examine your losses, what is the character of your loss. Whatever is material, howsoever small it is, to establish a paper trail, to establish an audit trail, discharge your owners. It's a bill, voucher, email, memo, news extract, whatever it is, document it. The best part is that The moment you're able to establish that the loss is because of costs and not related party transaction, you've done your job. And that is what the government expects. That is what the transfer pricing documentation expects from you. The judiciary is very clear. They support you as long as you have the documentation to prove a particular decision, a particular set of losses. They are very happy with you. They will allow it to you. That's very clear. Again, you still have an option to make adjustments. Wherever you have losses, you will have issues of capacities, forex, and therefore the issue of adjustment. Karthik, over to you.
Thanks. Next slide, please. So I think what Sunil has been doing in terms of taking you through the various situations of losses, etc., is also again touched upon the aspects of documentation which are qualitative in the sense of trying to explain the story from the perspective of what the company has been facing. But that's just one side of the story. The other side of the story that will also require equal attention is on the qualitative side, on the quantitative sides rather. So what I mean by that? So the primary objective, of course, of transfer pricing is to ensure or demonstrate that your transactions are at arm's length. The way I do it is to compare my transactions or my financial results with third-party independent companies. And the way we are able to demonstrate it, the way the whole transfer pricing thing works is based on, ultimately boils down to numbers, and therefore it also becomes important for us to be able to justify or document these things from a quantitative perspective as well. And that's where the issue of economic adjustments come in. Now, the good thing is the Indian regulations do allow for this, because they do realize that it's not always easy for us to necessarily have find another company which is exactly the same way as us, or possibly facing the exact same situation that we are in a given situation. So each person, each company will be impacted by things in various intensities, and therefore there will be those differences. So the regulations in fact require us to ensure that we choose comparables which are not materially different, or we have to ensure that reasonably accurate adjustments are made to ensure that the data cases which we are wanting to establish the arm's length nature are reasonable and accurate. And therefore, as I said, the economic adjustments is where is the way to be able to carry out this exercise. Next slide, please. So in terms of trying to cover what is the economic adjustments that we can do, we have basically looked at 4 types of adjustments that we've generally over the last many years we've seen companies having used, and to some extent also been accepted even from the judicial point of view. The 4 being capacity, working capital, foreign exchange, and depreciation. Next slide, please. So what is capacity adjustment? Capacity adjustment is basically to sort of capture instances where, for whatever reasons, I have not been able to run my factory at full capacity or run all the shifts, and it's not necessarily restricted to manufacturing entities itself. It can also be looked at from a service industry perspective, where we have many employees on bench, or we've not been able to fully utilize their hours that is available for billable hours, being able to bill that out to customers because of various reasons. The reason why a capacity adjustment becomes necessary is because typically any cost structure will involve 2 components of it being fixed and variable, and we all know that irrespective of what's the intensity of the operations, fixed costs have to be incurred. For example, when Sunil was talking about having to pay rent, even when most of us are working from home, so that's a fixed cost. I mean, it's not something that you can avoid necessarily. So and of course there are the variable costs as well, and more times than not we end up see situations where the profitability of the company is not even sufficient to cover these fixed costs, and therefore, we'll have to identify what quantum of that fixed cost is the one that we believe are being incurred, which are non-recoverable because of reasons, of not being able to perform at the or operate at the level that we wanted to, and then make reasonably accurate adjustments quantitatively to be able to uh, uh, to make that differentiation or bring about that differentiation and demonstrate that impact. The good thing is, of course, as I said, there have been various rulings over the last many years where the capacity adjustment has been accepted by the courts in India, and therefore this is one good option that people should consider looking at in their facts of the case where, for whatever reason, they've not been able to recover their fixed costs fully. It does make sense to look at capacity as an adjustment that can be looked at. Next slide, please. The second adjustment that we have again seen being used is the working capital adjustment. Working capital basically adjustment flows from the fact that companies have largely been able to manage their working capital costs better or not so better because of again situations impacting them. This would impact basically cover your debtors, creditors, your inventory turnover, etc. All of this constitutes your working capital, and therefore how best we've been able to manage it vis-a-vis the companies that we are intending to compare with is what is the issue in hand. And again, wherever we've not been able to utilize or turn around our working capital well, or where the costs relating to working capital are higher for us because we've not been able to fully, or the ratios have not been great for us, that again is something that we'll have to look at and make suitable adjustments. Of course, the key challenges that we've seen over a period of time in terms of being able to quantify a working capital adjustment are in certain instances where, let's say, there are overseas tested parties, and then to be able to get information of the comparables is one challenge. The other instances we have also seen where it's probably a little complex to be able to carry out a working capital adjustment are in instances where a company has multiple divisions, like how Sunil was saying, where a company can be doing have multiple divisions within the same legal entity, and where one segment or one division may be doing well, the other segment may not be doing well, and then how do we then be able to very reasonably be able to split the impact of the working capital relating to specific divisions is something that will also have to be kept in mind while carrying out this working capital adjustment. Next slide, please. The third adjustment that we wanted to also touch upon is in terms of foreign exchange, which again I think Sunil did touch upon. Basically, forex adjustments can be done in two ways, and is of course also necessary for the reason that whenever, of course, during the year when we do a budgeting, we would have estimated the forex rates to be at a particular point of time, and due to various reasons, economic factors, political factors, etc., we do see a wide range of fluctuations in forex rates over a period of time in many instances that we've seen in the recent past as well. And these sudden spikes in foreign exchange rates do make a big impact for various companies, because we're at least companies which are largely dependent on imports for their raw materials, and also for people who are primarily again export oriented, where any change in exchange value will make a big impact in terms of what their realizations are. And therefore it is important to be able to justify or quantify in terms of what's the impact, and then be able to make necessary adjustments to ensure that the impact of foreign exchange is eliminated or reduced to the maximum extent possible. As I said, there are two ways of doing it. One is to possibly look at making suitable adjustments to the foreign exchange rate itself, maybe taking an average rate of what you expected it to be vis-a-vis how the variations have been, where the variations can be even 10-20% in many instances, and being able to quantify the impact. The other way to look at it is, of course, also to completely eliminate the impact of foreign exchange gain or loss from your financial results and be able to have a neutral, neutral numbers to see that, okay, assume as though I have not incurred any exchange loss again, and then see what my performance is vis-a-vis the others, and that sort of nullifies the impact of forex for me as well as for the comparable companies. Next slide, please. Fourth, of course, is on the depreciation. Again, particularly for companies which are very capital intensive, depreciation is one big component of the cost in their P&L as well, and it sort of comes back to the issue of capacity, where capacity can also be in instances where it's not necessarily capital intensive and it's labor intensive as well. All of those things can also have an impact. Depreciation particularly comes into play where there are the business is very capital intensive, and in India, of course, there are multiple options in terms of how you can depreciate the assets, and there are quite a bit of flexibility available, and different companies tend to adopt different policies based on their estimates of what their life of machinery is, and then again specific to the industry, and of course sometimes based on the group policies as well. And all of these things tend to make a again a big difference in the quantum of depreciation cost that gets captured in the P&L of companies from one company to another. And this does tend to again create a big impact in terms of how the margins look like, and therefore it does make sense to look at this closely and see if reasonable adjustments can be made in this regard as well. Couple of key things that I wanted to touch upon on the adjustment side is, one is as again Sunil was emphasizing, and I can't emphasize any more, it is very important to be able to document all of these things. One is, of course, collecting all the qualitative aspects of the documentation, which Sunil did touch upon in terms of the evidences, communications, disclosures in the financials report, etc. And all of that will also have to be necessarily stitched together and presented as the situation or the actual story that we are facing in the actual transfer pricing documentation, because that is the primary document for you to be able to defend your positions. And no less emphasis on the fact that it is not necessary to be able to just do these adjustments from a number perspective and put that in the numbers in the document, but it is also necessary to be able to justify that, and as to why these adjustments are being carried out, stitching together all of these facts and then explaining therefore there is a need for an adjustment and documenting that specifically in the transfer pricing documentation. And the second key point that I wanted to touch upon is on the timing as well. As again, Sunil was giving the example of how the tax officer in an instance was saying it's an afterthought. In the past as well, I guess it's been an experience where over a period of time, maybe it's something, adjustments are something which have been overlooked in the earlier years, because possibly people were not aware if this is something that a tax officer will accept or not, and therefore maybe there have been operations, though there have been a need to do it and the willingness to do it, but may not have been done at the time of the documentation itself. But now, with the years of experience that we've seen, and also of course the various judicial rulings which are there, which clearly gives us the comfort that whenever the facts are presented before the courts, and there is a substantial support made in terms of arguments made in terms of justifying why an adjustment is warranted, the courts have accepted it. So now we know that it is something which is acceptable by the courts as well, and therefore I don't think there is any reason for us to wait till when the notice comes or the audit starts for us to think about these documenting these adjustments or think about how we can do those things at that point in time. Rather, it's very important for us to be able to do that right at the time when you're doing the documentation. It also helps from a timing perspective, because 2 years down the line, it is all that more difficult to be able to gather the data required to do these things. Then rather do that upfront when you're doing the documentation itself, because all those things are very readily available with you. To then as of now, so we've talked about identify, we've talked about analysis, we've also talked about documentation, both from qualitative perspective and in terms of economic adjustments that can be done. So we've done all of those things in preparing our documentation. We put our best efforts to be able to do that. The next big question, of course, is will it pass the scrutiny of the tax officers? And I think that's where that's a big step to also to be crossed as and when we face it. And I think given Sunil's extensive experience in handling litigations, I think I want Sunil to sort of give us some insights on how we can do the defending part before the tax authorities.
I know, Karthik. I think that's always been a challenge. Next slide, please. The next one, please. I think dispute. India has this infamous regime of carrying forward a particular matter to 10, 15, 20 years, 25 years until it achieves finality. The first time I made this chart, I thought this was very impressive until I put in the timelines. The moment I put in the timelines, I realized that this is a scary piece of paper that we have created. But I think this is a reality. Although there is a lot of scope, the government has done a lot of work in sort of optimizing the timeline at the initial stage, the stage that you see between the conclusion of assessment and going to CIT appeals or dispute resolution panel. I think this stage, the government has done a lot to sort of optimize the timeline. But beyond that, it's managed by an independent judiciary. You cannot press the judiciary beyond a particular level, and the judiciary can only handle so much at a particular point in time. They have, over the period of time, created specific courts dealing with the tribunals, dealing with only transfer pricing matters, but it's certainly not enough. There is a lot more to be done. Now, just as an approach, I'm sure you would have all gone through this at some or the other stage, but what are some of the key aspects we thought when you look at your litigation strategy, what is it that you generally look at? Certainly time is a big factor here. You're going to be before the courts for a long period of time. Certainly, if you were to approach a high court, get a decision out easily between 6 to 10 years is something that you should look at. Versus cost, higher the time, higher the cost. Obviously, you should know the cause that you're fighting for, and what is the benefit, therefore. That is a classic comparison that you would do when you sort of go beyond the CIT appeals or the dispute resolution panel. This is the call that you have to take. It's a very sensible thing to do. Again, the decision is based on a very critical factor, that is what is going to be the probable outcome and how does it impact the decisions that have been taken in the previous years and the strategy that you have for future years. Very, very important. How much of tax do you have to pay to be able to survive through this process? Is 20% enough? Yes, no. How much more you will have to pay? How do you deal with penalties? There are penalties, as you would know, that range between 50 to 200%, and therefore you must take that into consideration. And last but certainly not the least, the tax that you do not choose to pay, the tax that you agree with the tax officer that you will pay only on conclusion of proceedings. What happens to the interest on that tax, outstanding tax, right? As you know, the interest counter never stops. It gets ongoing by 1% a month, and therefore this is a very, very critical process that you have to follow today. Next slide, please. The next slide is a typical dilemma that people face. We call it a decision matrix between whether to go to the dispute resolution panel or to go to the CIT appeal. We thought we'll just touch upon this aspect. So this is a stage where you have a draft order, right? And you are deciding whether to go to the DRP or to the Commissioner Appeals. Now, DRP is a 3-member body. CIT Appeals is a 1-member body. DRP also only look at international tax cases. CIT Appeals, now you have specific CIT appeals who look at transfer pricing cases. So there is competence on both in both these bodies, but the objectives are a bit different. So DRP is a more of an administrative body, and therefore the decisions that you expect are more administrative in nature. So anything, let's say, to deal with a computation. So for example, they've chosen comparables, so you could question comparables is easy to argue before a DRP. There is a difference between in the manner of computation of the margins. This is also something, if this is the main issue, I would like to take it to the DRP. Again, if you have legal aspects, don't expect the DRP to do much here, because the 3-member board, their mandate is more on the administrative side. They are there to see that the tax officer has followed due process. The assessment has been done in a specific manner. That is the reason that when you go to the DRP, you have a draft order and not a final order. So they are still verifying what the tax officer has done is correct or not. And therefore, they don't look at much of legal aspects. Whereas the Commissioner Appeals does look at legal aspects also. With the DRP, of late, last 10 years, DRP has acted, they have gone into the shoes of the tax officer, and they have sort of started taking decisions for the tax officer. So if the tax officer says that your margin should have been cost plus 20, they might come back and say, no, it should not have been 20, it should have been 25. And this has happened very, very often. With the CIT appeal, although the CIT appeal has similar powers, you will not see that happening much often. The focus is different. The focus is more decision-based rather than verification-based. DRP, the biggest advantage that you have is it's a time-bound decision. You get a decision normally in 9 months, forget the COVID period. And the other big benefit attached here is that until you have a decision, there is no tax that you have to pay. Your order is still draft. You don't get to discuss more about tax payments. But before, when you go to the CIT appeals, it's you will have to pay around 20%. The board says pay about 20%, and therefore it is likely that you will pay about 20% before you go to the CIT appeal. So take your pick. But if the matters are more straightforward, let me summarize. If there are issues relating to comparables, arithmetic issues, less legal issues, go to DRP. Also, if the demand is very high and you don't want to be waiting until the time CIT appeal decides, there is no time limit is going to follow. Your target is DRP, because through DRP you could straight away reach to the tribunal. And therefore, it's a call. It's anybody's call. But then these are the factors that we thought will help you. But there are other avenues also. There are avenues in the shape of MAP, famously known as APA in India for transfer pricing purposes. You have the safe harbor rules. Karthik, why don't you discuss that? Next slide, please.
Yeah, sure. So, of course, there are two approaches to it. One is the reactive way of, waiting for the notice to come, and then we can go through the normal audit process of CIT appeals and DRP. And of course, we have what I sort of tend to call it as a proactive basis, where we can look at two options, which is basically APA and safe harbor. The Indian APA program has now been there for about 7 to 8 years, and close to 1,000 plus applications received across unilateral and bilateral APAs. And the last we are aware of is about close to 304 or 5 APAs have been signed, a mix of both, again, unilateral and bilateral. The key advantage of an APA is the fact that it covers a larger period, and it is proactive, and it is upfront. You don't have to wait for the notice to come and all of those things, and then you can upfront go negotiate, agree, present all the facts, and do a be able to negotiate and conclude on what you think what can be a reasonable arm's length basis of entering into transactions with group companies. Of course, the downside to it is that again, based on the statistics that we have, we've seen that the average time taken to close a unilateral APA has been close to 3 years, and for the bilateral APA has in fact been close to 4 years. Even then, I think there has been good traction, as I said, 1,000+ applications and close to 300 APAs signed. And we do see a healthy mix of companies which have gone into the APA. Of course, primarily most of them have been services, but we do see a good amount of interest from manufacturing entities as well, and APS having been concluded in that sector as well. So it's not just about services sector, and therefore it's easier, and therefore manufacturing is not something that will not happen. I think there's been a mix of both. And then from an industry perspective as well, we see that about 5% are from an automobile industry, and 5% again from industrial and commercial goods, and about 16% from the IT sector as well. Next slide, please. And a wide variety of transactions have also been covered, including complex transactions such as royalty and technical services, etc. And of course, coming down to more routine transactions as well in terms of raw materials and basic services being provided. Not surprisingly, TNMM has been the most used method, which is also generally the one that most people tend to approach or rely on for the documentation purposes as well. But of course, I think the interesting thing to notice here is that there are about 8 cases where profit split method related APS have also been signed. Profit split method, of course, we've known to be something which is complex to sort of implement and use as a method to defend your transfer pricing, but that has also been done, and there is no restriction on that. So in instances where we believe a profit split method is more relevant, and that is also been accepted by the government authorities. Key thing that we wanted to also highlight is the fact that now the recently concluded APAs, it's been mentioned that the APA has been signed covering the COVID period, and sufficient adjustments have been made to ensure a differentiate between COVID and non-COVID years as well. I think which is a very good sign, and therefore gives all the more reason for companies to look at APA as a good option, because you have the option of 4 previous years and 5 forward years, a good 9 years chunk of time that will get covered, and you will get a certainty around it. Of course, there is the timelines involved, as I said, about 3 to 4 years that you might take depending on unilateral or bilateral, but I think it's worth the effort. The other key thing that also is something that wanted to touch upon is that there have been instances in the past where, particularly from a MAP perspective, where certain countries, like for example in Germany, we don't have the Article 9.2, which provides for corresponding adjustments, and therefore the whole process of mutual agreement was not something which was being activated between India and Germany. The good thing is in 2017, the government has come out with a press release where they've said that irrespective of the Article 9.2 being there or not, the government is very happy to accept applications for bilateral APAs. I think that's a good opportunity for countries like even Germany, where though the 9.2 Article 9.2 is not there, that should not act as a restrictive thing to be able to approach for a bilateral APA. And interestingly, I think we've seen that there are about 4 bilateral applications from Germany which have been filed, though of course there's been no progress on it from what we've seen from the statistics. Next slide, please. The other option, of course, is the safe harbor, which is a lot more shorter in terms of the duration of how quickly it happens, because this is an application which you can file again for a period of 3 to 5 years at a stretch, or on a year-on-year basis for renewal. And the good thing about safe harbor is that you will know whether you're eligible, not eligible, your application is accepted or not in a very short time, within a few months of filing your tax returns and compliances as well. And once accepted, the litigation around transfer pricing specifically gets shut permanently. From that perspective, of course, it's a great option, and it's on a year-on-year thing, and then it's something that we can look at as a something that we want to use in a particular year or not, depending on the circumstances, etc. Of course, it does come at a higher cost in terms of the markups or the profit expectations being higher compared to what what we may be willing to or we believe is arm's length. And of course, that's why it is safe harbor. And to say that if you have earned beyond what is normal, we'll definitely not look at you or scrutinize you more. The other sort of disadvantage, of course, at this point in time is the fact that the safe harbor is not very wide. It is restricted to particular types of industry or transactions at this point in time, as compared to an APA where any transaction can be taken up before for a negotiation and an agreement in an APA. The other key point, of course, is also that the last safe harbor rules were applicable till FY 18-19, which is March 19 fiscal year in India, which was extended by another additional year till 20. For the current year, we've not seen any instance come up or any announcement being made by the government. We're hopeful that that will come up soon, and this benefit is extended to all the companies as well. And one thing that I would also want to sort of think about is, again, why safe harbor may not be all that. We've not seen a lot of adoption of safe harbor, as I said, primarily also because of the limited number of industries that is being applicable to. One is, of course, the rate. But it does suit companies which are possibly in having a stable kind of a growth outlook in terms of their operations and all of that, and it does give them a lot of certainty. And people can, of course, look at AP as an option at a later point in time, and then to suit the requirements as and when, depending on their business plans. Well, of course, it will have to be kept in mind to see that how we will, in an AP application later, try to justify possibly a lower markup that we may want to negotiate for compared to what we may have accepted from a safe harbor. But I think, given the experience that we've had with the AP authorities, we've seen that they've been very pragmatic and practical in terms of understanding the situations a lot more better in compared to when we have to do that from a post facto sort of scenario during the normal course of litigation. So I don't think that should, in my view, be a showstopper as well. Next slide, please. Of course, I think the big change that has happened over the last year has been, the way the traditional litigation has been happening in terms of where the notice would be issued, and then the tax advisors had the opportunity to physically be present before the tax officers, and make a holistic submission or representation before the tax officers. Now that has been eliminated in terms of adopting a more technological way of doing things, where the exchange between the company and the tax officers happen online through submission of documents strictly. Of course, there are options where you, based on a specific request, hearings, not a physical hearing, but a video conferencing kind of a facility would be provided, where people can still interact face to face and explain their positions. But primarily the objective is to ensure that the audit process is completed through minimal interactions between the company and the SSE. This is primarily done with the intention of fastening things, and also to eliminate any issues that people would have faced in the past in terms of various things. So and this is something that we've looked at from an assessment perspective and from an appeals perspective as well. And the first season is completed, and our experience has largely been that wherever we've been able to justify the positions in a very simple, lucid manner with enough examples, and making the submission as speaking as possible, it's been helpful, and we've been able to get some good orders as well. I think that's where the key difference is now under the faceless regime as compared to before, where even if your documentation was not self-speaking sufficiently, you had the opportunity to be able to be before them physically and be able to fill in the gaps. but that is one thing that is not going to happen at this point in time, and all the more emphasis again to ensure that your transfer pricing documentation is built robustly in terms of being self-explanatory, and also the further submissions that you make are also simple and lucid and are quite self-explanatory, because nobody will be there to be able to again explain or justify them. So I think with this we wanted to sort of conclude our discussions today, and over to
Savina, do you want to take questions now?
Yes, good afternoon, everyone. Thank you so much for the presentation. So we have a few questions. The first two questions I'm going to combine and put it to Sunil. Question number one is how transfer pricing can impact the company's cost. And question two is, being a European MNC, we want to know the adverse and positive impacts, if any, in case of transfer pricing and related party transactions.
Okay, transfer pricing, as I said, Sabina, is a very specific aspect. It deals with a specific transaction, and there are no same rules that apply to same transaction, to different transactions. So I think I wish the question was very specific, but it's still it's there. I think I can only answer a very high level sort of a viewpoint. So the most simple thing is that when you talk about transfer pricing, when you are talking to your associated enterprises, let's say you're buying something, okay? Simple typical case is that your group company is going to sell you at a price at which they sell to the external customers, okay? That's the first case. Second case is the only possibility is that they could sell you at a slightly lower price, okay? Now, in situations like these, the tax officer does not want to see the other prices. It is your responsibility to substantiate, establish that the price at which you bought is equivalent to a third-party price. Nobody, the tax officer is not going to ask you, show me this or show me that. He's only going to say, show me or establish that your price is the arm's length price. Now, if there is a fault with your price, indeed you're paying a higher price than what the price that is being offered to others, or let's say different buyers, then the way it can impact you is that the tax officer is going to reduce your purchase price to the extent he feels that the price is excessive, okay? And a reverse thing would happen to sales. You are selling to the group company at a lower price than the market. The tax officer is going to understand. If you're not able to justify, he is going to increase your income. So in both cases, either your purchases are reduced or your sales are increased, you actually end up paying a higher tax in India. And this time with interest and penalties, right? So just to answer the question, it impacts your financials in a drastic manner. Penalties are not easy to handle. And once you have a transfer pricing adjustment in 1 year, believe me, this becomes a benchmark for the subsequent years. So you face a transfer pricing adjustment in 1 year, you will automatically see a notice coming to you the subsequent year. So it impacts you in more than one ways.
All right, thank you very much. Now the third question is for Karthik. The question is, how do we treat hard to value intangible under BPS attests to this? How do we get a consensus within its transfer pricing guidance?
So, I think my view here is that, as the name itself suggests, it is hard to value, and a lot of assumptions go into terms of making a valuation at a particular point in time, and then given the situation, does it make a difference? Of course, a lot of assumptions that would have been made, maybe all that more difficult to make those assumptions at this point in time, or may be able to have a reasonable outlook of how things can look in the future, basis which the valuation can happen. I think the approach will still have to be the same. We can't necessarily avoid the situation or look at. I think what's more important is the fact that therefore all the more emphasis on being able to justify the assumptions that we make at this point in time, and we are doing the valuation, and being able to justify that a lot more, or being able to document that and justify that in a better manner. I think that's what will help be able to fit in these hard to value intangibles valuation at this point in time, and given the situation.
Sure. Thank you so much, Karthik. We have 2 more questions, then we are going to close the session. Question 4 is for Sunil. In case of service industry, what are the key documents to be maintained, and what range of markup needs to be maintained in case of IT industry?
I think IT is a very specific case. IT, Karthik also spoke about the safe harbor rates that were offered to IT companies. So I think I will address the margins issue first. And again, I'm not going to say what you should do or what you should not do, but we can share our experiences with you. So IT, from an experience perspective, let's say ITES services, IT-enabled services, we have seen a trend where they were accepted anywhere between 15 to 18. Karthik, feel free to add wherever you wish to. If the services are more on the software development side, it was a notch higher, maybe 17 to 20. So that is my take on the margins. Anything on margins, Karthik, from your side? You are in Bangalore, you know the IT very well.
Yeah, so I think largely that's been the trend, but I think one of the things that we hope that this will happen and happen soon is, of course, the extension or the new safe harbor rules coming in as well. I think which should also give us an indication of what the government itself thinks is over and above, and then should give us an indication of therefore what may be relatively more acceptable as well. And again, I think one of the things that we did mention in the previous session as well is to ultimately look at what the comparables are talking, because ultimately that becomes the basis for us to be able to take any call on what finally is the markup or what is the best thing that we can do in this situation. So I think wait a little more, hopefully more data will come in, and then we're able to run a benchmark, and then it should give us a more realistic view of what the markup should be.
On Sabina, on a documentation perspective, I think that will essentially depend, and it has to be linked with the agreement, intercompany agreement that is there existing between the company and the head office. And whatever you were supposed to in terms of the contract render to the parent or the group company, essentially the documentation trail has to establish that these services were requested for, these services were executed on ground in India, and they were delivered in the way asked in the agreement. They were delivered and acknowledged by the service receiver. So the entire audit trail, the paper trail, has to be very clear in that aspect. We have seen off late people will just do a contract and they will assign a margin to it, and then they would feel that there is no other documentation that is necessary. I believe the question that has come, I'm assuming that they would have suffered a blow on that approach itself. And therefore the audit trail must be there right from the time when the service is provided. So if I was to look deeper, I should be able to see what work was also done. So in these cases, working paper, for example, if they're talking about coding job, right, in the IT industry, coding is something that is assigned to India. If they had indeed done coding, there will be a workflow of the coding that will be available, and that would have been certified by the headquarters before accepting it. The entire workflow has to be there on record. And it's an endless discussion, but this is the basic.
All right, thank you so much. I think that made it very clear. Then the last question for today is again for Sunil. What is the GST applicability on marketing service fee paid from a company to its branch in India?
Unfortunately, we are both not GST experts, but generally, as we understand, very limited. GST is something that has a concept of import of services. So any service that you consume in India, again on a very high level basis, please don't take my word for this particular aspect because we are not experts. But GST has this concept of import of services, and again, that is very specific to the nature of services that you are rendering or you are paying for, and therefore it would help if you can see the contract once. Very happy to advise. We have a full-fledged GST team at both our offices in Bombay, in Delhi, all across. Very happy to examine that and give you a clear answer.
Sure. Thank you very much, both of you. Now, let's come to the final part of the vote of thanks. I will keep this very short. And first of all, thanking our audience for your patient hearing and listening. Thank you for all the questions. Thank you, our two eminent speakers, for making things so, I would say, relatively easy to understand for someone who doesn't deal with it every day. Let's put it this way. Thank you very much for sharing so many examples. And thank you to both the teams, ASA and IGCC, the backup teams behind the scenes to make this webinar possible. We will share the PowerPoint presentation of both webinars and the videos with all the attendees shortly. If you have any more questions, please directly email to the speakers. You can see their email IDs here, or otherwise send them to us and we will forward them to the speakers. And goodbye. Have a nice evening and afternoon. Hope to meet you soon. Bye, everyone. Thank you.
Thank you, Sabina and team. It was a pleasure. Thanks. Bye-bye.
My pleasure. Bye. See you.
Thank you.